Volatility risk premium. Let me break it down so it can consistently be broke. A lot of us look at this type of chart and we look at the difference between forward volatility, which is the VIX, right? 30-day forward volatility, which, most of the time VIX is, or all the time when you see that VIX number, it's annualized. Then we have historical volatility. Which is basically the movement in whatever stock you may be looking at. In this case, we're looking at SPY. So this is forward volatility for SPY, and in terms of VIX or SPX, forward volatility in terms of S&P 500, and historical volatility in terms of S&P 500. When this thing is in the negative, it's because SPX is moving a lot. So in June of last year, we were on market lows, very volatile times. We were moving a whole lot, right? Big moves, mostly to the downside. Same thing in November of last year. When there's some angst in the market and we're expecting something, but it hasn't quite come yet, that's when VIX is outperforming the moves in the market in terms of historical volatility. And that's when you see this higher. So as we were getting rates and rates were going higher, and yes, the market was moving down, obviously, because we were moving off of highs in January of 2022, we saw elevated VIX, right? That's where you saw this metric above 5 in the 7, 8, 9, 10 range. So those are the times. If you look where we are right now, not particularly inspiring in terms of ability to sell volatility. And so one of the things that people always talk about with volatility risk premium, you harvest volatility risk premium by selling vol. How much can you reap between forward volatility and historical volatility? That's what this volatility risk premium chart shows you, right? So right now, not a whole lot to sell. Let's look at move ahead a chart, and now we can see this thing sort of expanded out. I always say you can really gain a lot more from seeing widespread differences. So a lot of you will see this huge negative, bar on here and kind of be like, "Whoa, what happened there?" Obviously, that was COVID. Those are the times where the market was moving really strongly, if you can remember, and I'm sure most of you do. Those are the times you see the market moving really big. And of course, historical volatility was way outpacing the VIX. At one point in time, the VIX was in the 70 range and historical volatility was like 110. So therefore, you get like a negative 30. So big moves. Of course, those are the times where you're like, you should be able to sell volatility big, and you could, and you can, but you need the market to calm down to be able to harvest the volatility. Otherwise, unless you're choosing a directional situation, like in that case, if you just sold puts, well, that's more directional than just selling volatility. You're selling volatility and direction in that case, or you're choosing a direction and selling volatility, but it needs to work. If you just sold calls, well, maybe it worked for a little bit because the calls were so elevated, but then if you run the risk of the move going that much higher, of course, you get beat on it. So anyway, just looking at all of this, you can kind of see some of the things we've dealt with over the last couple of years. And I probably don't have everything, but you have COVID in there. You have the meme period where volatility was pretty elevated during that January of 2021, if you remember. You have Omicron in November of 2021. You have the rates situation we just talked about in March of last year and also May. You have market lows in June of last year, and then you have market lows in November last year as well. So this is just a look at volatility risk premium, to look at the difference between expected volatility and historical volatility. And